Hello and welcome. This is Ray from Regos Consult and Enterprises, and today in this video I want to walk you through how to make a full-time income trading the forex market with beginner friendly strategies. Now I'm going to be going into details in this video, so I want you to listen attentively. Make sure you have a pen and a paper around you to jot down so many things, because I am going to put out a lot of information in this video, so it's something that you don't want to miss out. You don't want to miss any information, so make sure you have your writing materials to write everything down that I'm going to be showing you in this training. Okay, I'm super excited to share these stuffs with you. Okay, now let's dive into this without so much ado. Okay, so firstly I just want to make this ending disclaimer. Okay, the information that I'm presenting in this video is intended for your educational purposes only. Nearly 80% of people who trade CFDs do in fact lose money. We are not making any claims as to income you may earn. And fourthly, this is not a get-rich-quick scheme. Alright, having said that, so let's go into the other parts of this video. So what I'm going to be showing you today, it doesn't require years of experience, it doesn't require you to have a university degree, it doesn't require you to have technical skills, it doesn't require you to have to approach people, and it doesn't require you to deal with customers. Now, why is this different? Okay, you're going to be learning an invaluable skill. Now, a skill you can learn once and use continuously again and again to take profits out of the market. High liquidity. You can deposit and withdraw from your trading account immediately, simply moving from one account to another. No ownership, okay? Unlike the property market, you can buy and sell assets without ever owning them. Now, this is also highly accessible in the sense that you can start trading with as little as $100. No qualifications needed to enter a multi-trillion dollar market, which is the forex market. Now, here are my goals for this training. I'm going to show you how we use compounding to build up large, highly profitable trading accounts, and how you can too. I'm going to show you how casinos make money and how we use similar strategy in our markets to make sure we are consistently profitable over the long run. I'll also be showing you how we have people like you quitting the jobs and trading full-time, taking advantage of leveraged accounts. Now let's cover the three keys, okay? The first key we're going to cover in this training: trading forex like a casino, how to always come out on top. The second key is why so many traders lose money and how you can avoid this. And the third key is compounding your money, a $1 million strategy. And you can start implementing these strategies right away today. Now let's go to the first key: trading forex like a casino, how to always come out on top. Alright, so you've probably heard the phrase, the house always wins. And this is very true. The casino always wins, no matter what happens. Which is why they give you free food, refreshments, because the more you come back and bet, the more they win. Well guys, I'm going to be showing you exactly how they do this, and how as professional forex traders, we set ourselves up just like the casinos to make sure that in the long run, we are consistently profitable. So basically, casinos read their games in a way which gives them a statistical edge over the players, so that they end up at any point in time having a higher probability to make money than the players does. So here is how this works. Let's take a typical example, the game of roulette. So in the game of roulette, you have a giant wheel made out of 32 different numbers, and when you throw a ball, it literally lands on any number at random. And what you do is you bet which number you think it would land on. For example, will it land on an odd number or an even number? Will it land on a black or a red number? So a common bet would be to bet on a black or on a red. For example, here is a red number and here is a black number. A common assumption people have is it either lands on black or red. So I have a 50-50 chance of winning this bet. Well, That's incorrect. You wouldn't have a 50-50 chance of winning because the casino always route the games in a way where they have a better chance of making money more than the customer. But check this out. On a roulette board, you have 18 red numbers, you have 18 black numbers, but there are also two green numbers, the 0 and the 00, as you can see on the screen here. So your chance of being right is actually 18 out of 38. The casino's chance of being right is 20 out of 38. Because if the ball lands on any of the greens, the casino wins as well. So if you work it out, guys, the player has 47.3% chance of making money, while the casino has 52.7% chance of making money. So what's the casino's edge over the players? The casino's edge is 52.7% minus 47.3%, which is 5.4%. Therefore, the casino has a consistent 5.4% edge over the player, and that's how they end up consistently making more than the players. But what does 5.4% as an edge actually mean? It means that in the long run, over 1,000 bets, for every $1 a player bets, the casino will consistently pocket 5.4% of that. Therefore, if $1 million is bet, the casino will keep 54,000. So the more people play, the more the casino makes money. Okay? Let me explain this in another way. Let's say for another example, if you have 1,000 bets and each bet is $1,000, okay? So that's 1,000 times $1,000. That's give us $1 million bet, right? In total. Statistically, out of 1,000 bets, the casino wins 52.7% of all bets, while the player wins 47.3% of all the bets. So this means the casino will win 527 bets and lose 473 bets to the players in a given 1,000 number of bets. Let's break this down, okay? Over 1,000 bets, the casino will make $527,000 and lose $473,000. So if you calculate the difference, the casino made $54,000, okay? Therefore, over 1,000 bets, the casino stays profitable as they are up by $54,000 net profit. And the reason I'm showing you this is for you to see how, as professional traders, we can position ourselves to have a statistical edge over the markets, and how we replicate the business model of the casinos to make this happen. The second key I'm going to show you here is why 80% to 90% of people who trade Forex actually lose money. So the reason most people lose money is because they trade without a plan. They don't have a plan or strategy. They buy based on rumors, based on emotions, based on opinions, or based on tips. So for most people, when they make trades with no strategy, what's the chance of them being right? It's a 50-50 chance, isn't it? Fantastic. Well, it's random. It either goes up or it goes down. Now you could say, if it's a 50-50 chance, well, then it isn't bad, right? Is it? And I will say, you're right, it isn't. But however, it is worse than that. Remember that when you go to a casino, you bet, let's say $1, for example. If you lose, you lose $1. If you win, you win $1, right? Great. So you're only ever risking $1 to make $1. But when beginners start trading Forex, the problem is, because of their emotions, they end up losing more when they are wrong and making less when they are right. Let me give you an example. Let's say a beginner, you open a random trade, you enter a position at $10. It doesn't go your way, so you say, heck, I'll hold on, it will come back into profit tomorrow, okay? Now tomorrow comes, is at an even bigger loss, but your emotions won't allow you to take that loss. So you say, okay, I'll wait, surely it will come back into profit tomorrow. Then the trade comes, only for you to realize that it isn't coming back and you should have closed this trade much more earlier. Then you sit out there and then you end up sitting there with a big loss on your trading account that could have been avoided because you've just wiped out or blown your account. Another reason is the instant gratification cost. Now, when they are meant to close at a profit of, let's say, $105, they rather close at a $5 profit. Then the reason is this: on the flip side, when they make a trade and it starts moving in their direction, instead of holding on to it until it reaches their profit targets, they close the trade earlier since they want to secure their profits quickly. And from the experience they had previously, they don't want to repeat that or maybe lose out the trade entirely. So they hurriedly close the trade before it gets to their target profit. So as a result, beginners win small and lose big, even though they are right 50% of the time. And so you can do the maths, okay? This means that in the long run, at the end of it all, you always lose money. Now, as professional traders, we can make money consistently by replicating the business model of the casinos. So I've explained how casinos rig their games. Now let me explain how, as professional traders, we do same, but in our market. So by studying the market and looking for repeatable price action patterns such as this one here, we're able to have a statistical edge over the markets. Like what we have here is called a rising wedge. Okay? Let me give you an example. There are three things that could happen when trading Forex. The market either goes on an uptrend, on a downtrend, or sideways. So let's look at what happens in an uptrend. So as you can see, the market doesn't go directly up, does it? It goes up on a wave pattern, right? Good. So it has its impulse, correction, impulse, correction, and so on. Okay? Now, what happens is this. When it corrects to a trend line, which is called the support level, we can start to see repeatable wave pattern. Okay? Now it hits the trend line. That is where the red line is. It bounces up. What do you think is going to happen when it hits the red line again? It's probably going to go up again, right? Fantastic. So as a professional trader, we buy here just before it shoots back up. And the question is it 100% guaranteed to go back up? No, of course, nothing is guaranteed. But when using these repeatable price patterns, it's not a guess or a gamble anymore. You could argue it's more like 60% chance. Meaning, on average, you win 60% of the time and you lose 40% of the time. So therefore, you have 40% chance that your support level is broken, but most of the times it's unlikely because from experience, you have seen the repeatable patterns. And if you lose 40% of the time and win 60% of the time, what's your edge? So this means that your statistical edge is 20%, which is better than the casino's edge of just 5.4%. And they are making hundreds of millions. So even if you are only right 55% of the time and wrong 45% of the time, that's still a 10% edge. Therefore, being a professional trader can actually be more profitable than owning a casino, if you think of it that way. And here's the best part. As professional Forex traders, we never risk 1 for 1. We always bet at least 1 for 2 or 1 for 3. So our potential profit on any given trade is always 2 or 3 times our potential loss, which is called the risk-reward ratio. And how do we make this happen? Simply by placing take profit targets and stop loss limits on all of our trades. This guarantees how much the maximum we can lose, and placing a profit target to guarantee how much we can win when we are right. Let me explain this in more detail. This is a market going sideways, right? Meaning it's in a range. So you can see the resistance level and the support level, okay? Say for example, the support level is $10 and at the resistance level is $16. What do you think will happen when it hits the support level again? It's going to shoot up, isn't it? Great. Now and again, is it a guarantee that it will go back up? Of course no. It's a probability, which is better than a 50-50 chance, isn't it? So based on its repeatable price pattern, you can work with a 60% chance it goes up and a 40% chance it goes down. Now let's say I enter a trade at $12. I have to place a stop loss at $10, meaning that if the trade drops to $10, my trade closes and I only lose $2. So by placing a stop loss, you guarantee how much you are going to lose when you're wrong. So you just need to make sure that your distance from your entry price, which is the price you buy at, and your take profit price, which is the top of range, is double or triple the distance between your entry price and your stop loss. So as you can see here, the top of range is $16. The entry price is $12. So that's a $4 difference. The stop loss is at $10 and the entry price is $12. So that's a $2 difference. So therefore, you're risking $2 to make $4. In other words, you are trading with a 1 to 2 risk reward ratio. So for every $1 you bet, you make $2 when profitable. And on top of that, you still have a 60% win rate because you are using a repeatable price pattern. And that's how you rig the forex market. And you can use this strategy to stay profitable over the long term. For example, out of every 100 trades, suppose your win rate is around 60%. So out of every 100 trades, 60 wins and 40 lose on average. And every time you lose $1. And every time you win $2 or $3. Therefore, over 100 trades of $1, you make $120 and lose $40. And using this strategy to stay profitable over the long run. So if you make $120 and lose $40, in other words, you are up $80 every 100 trades. And of course, realistically, you won't be trading at $1 per trade. You will be trading with much more. So your profits would be much more than that. And of course, there's no guarantee that you win 60 out of every 100 trades. But even if with a 50% win rate, you are still profitable. You are still making double your losses with a 1 to 2 risk reward ratio. And still making 50% return on your trades over 100 trades. This is how we're able to consistently make profits in the markets even when the odds aren't in our favor. We still stay profitable because of this. Now let's look at key 3, compounding your investment, a $1 million strategy. Now listen to this because it's going to be very interesting, okay? And this is one of the most important rules of all. Compounding interest or compound interest simply can't be stopped no matter how you look at it. And this was said by Albert Einstein himself when he says compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Now it works because it worked for me, it has worked for others. So why can't it work for you? And I want you to think about that as we go through an example of a 2,000 case study. How much you would make over a 5 years of compounding if you started with a $2,000 in a trading account. So make sure you stay tuned to the end. So let's run through the numbers. Starting with a $2,000 trading account, earning 10% profit per month, risking just 1% of your trading account balance per trade, trading 12 months per year. We're going to run through an example of how much you would make in 5 years from starting with $2,000 by averaging 10% profits per month. So you can divide the result by 4 to know how much you would have made by starting with $500. And you can also divide the result by 8 to know how much you would have made by starting with $250. Now in your first year, profit in year 1, you're going to make $6,276. In year 2, $19,699. Year 3, $61,825. In year 4, $194,034. Then in year 5, $608,963. And remember guys, you may say 5 years is long, but let's put that into perspective. The same 5 years it takes to get a university degree is the same it takes to achieve financial freedom, and you are halfway to becoming a millionaire. So, if you can't learn to play a guitar in a couple of weeks, if you can't learn to speak a foreign language fluently in a few months, if you wouldn't be able to pass your 4th year university exam after doing only 2 weeks of work, then you can't expect to master Forex trading overnight. So therefore, compounding over the long term is key. So you must be dedicated to this, guys, okay? So you simply focus on cutting down expenses and reinvesting that capital to build sustainable profits. And remember guys, you are never actually spending money when trading in Forex. You are simply transferring funds from one account to another. In other words, transferring funds from your bank account to your trading account where you trade and make profits. And with this strategy, do you think you can quit your job by year 3? With all things being constant, will this figure allow you to quit your job at $61,825? Think about that. Because if you apply the strategies that I've mentioned, if you take advantage of your risk-reward ratio, if you take advantage of your leverage to make large trades with small deposits to make profits, if you take advantage of compounding and build up your account instead of spending your profit, then you'll be successful at trading in the Forex market. So guys, I hope you got some value from the little stuff I've shared with you today. If you want to get started to start trading in the Forex market, there's a link in the description of this video. There's a link somewhere around this video. Click on that link and get started. And I hope you would find it an interesting journey. I might see you guys on the inside and in my next videos. Have a great day and thanks for watching.